In this video, we're going to look at 4 to 5 good quotes and tips from David Einhorn. Stay tuned. Hey traders, a very warm welcome to you. Okay, David Einhorn, pretty famous hedge fund manager. Let's have a look at some of his more famous quotes and tips and some not so famous ones, and let's see if we can take a few nuggets from there to make us better traders and investors. All right, let's start with number one. Number one is, my job is to figure out what will happen rather than what should happen. This is number one for a reason. I've chosen this one and I have got this one in order because this is by far the best thing ever. It just seems so simple advice when you look at it. Yeah, my job is to figure out what will happen. Okay, whatever. But when you think about that from not only from a trader's perspective, but also from an investor's perspective, it is so true. Too many times we can sit there and we can analyze everything. You can have economists analyzing stuff. You can get analyst white paper, you can get all this stuff. X plus X should equal 2X, whatever it may be. This is the formula, this is where it should go. This is the price, this is the earnings, this is the growth. We extrapolate it out. Here we go. That's where the stock price should be, right? That very, very, very rarely happens. Even the central banks can't get this kind of stuff right. Even the big funds and big investment banks who have got an infinite amount of money to analyze stuff can't get it right. So this is where traders have a bit of an edge, investors have a bit of an edge as the retail guy, because you can say, okay, what will happen? You know, what will happen if everyone wants to go into this stock? What will happen if this stock profit warns and I think that these hedge funds are in it or who are already pretty loaded up on the stock, or third time warning, whatever. It's trying to think a little bit more cleverly about your trades and your investments. That's from an investment perspective. Let's look at a trading perspective. Okay, what should happen if we break out of here and very structured? We should get a breakout that goes this much, this much. All right, that's all very well. That's the textbook. But what will happen? Well, actually, we know that we're in a downtrend environment that really perhaps won't do it, because a lot of people are ready to sell it because of this, this, and this. So more likely to be a fake out. That's what will happen rather than what should happen. So it's just thinking one step over from the kind of analytical answer to the problem that you're presenting or problem that you're trying to solve, i.e., which most cases is, where's the direction of this stock or market going? So just have a time to think about that, whatever kind of time frame you're trading, whether you're a short-term day trader scalping or you're rather a long-term investor. I think that's a pretty interesting comment from him. Okay, number two. This is one for investing, guys. Great companies are measured as companies that can generate lots of profit without needing too much capital, high ROE. So, you know, that's pretty much common sense. And actually, he talked about Joel Greenblatt's book. I don't know what the name of it is, but in a nutshell, he says, listen, if you can find companies that are generating good profit without being too capital intensive, they are companies that he would like to invest in, purely because I guess they can weather the storm easier. If they're not requiring a lot of capital, it means that if margins start to shrink, or if the market starts to shrink or something hits them, they don't have that massive capital requirement just to keep going. Well, a lot of those businesses that are very capital intensive, you know, you notice that actually all it takes is for a little tiny pullback in margins or a little tiny reduce in market share or something, and they're in trouble because they're putting so much money into it. So it makes a lot of sense. So he does a lot of scanning and invests in companies that, you know, are producing good profits, but on a very, very low capital requirement. And I guess he also would add to that he obviously wants things that he perceives have got good value and good potential to grow. But that's just the comment he made on that. All right, number three, illiquid assets carry a discount. What does that mean for us as traders? It means, listen, if you're thinking of buying a small cap stock, a penny stock, anything like that, you need to consider getting in and getting out of it. You know, a lot of people will pay a premium to get in because the spread is big. Now, obviously, he's talking about from a large perspective of large investments, he'd expect to get a discount because he can't get in or out when he wants. But the point of liquidity is that if you can't get in or out when you want into a company or out of a company, you know, you should expect a discount, because you aren't going to get out when you want to get out. You get out when there's a buyer to sell to. So just because it's falling through the floor, you can't find a bid for it just like that by snapping your fingers like you could with Apple or whatever company may be, Tesla or Microsoft or IBM or Tesco's or Vodafone. If you're in a company that's illiquid, you got to wait and either work that order over a long period of time, which is, you know, not convenient at all, and by which time you probably could have lost a lot more money if it's going against you, or you've got to wait for a buyer to come and take that big chunk of stock off you. So something to think about if you're buying kind of smaller cap stuff with a lot wider spread that's illiquid. Even if you and I, you know, with a relatively small account size compared to this guy, have to think about if we're looking to invest in that kind of stuff. Wait for that little sweet spot, you know, wait for the time when there's a bit of a flush, everyone's coming out the door, then you can buy it at a bit of a discount. You get the discount for the liquidity discount because people are paying the spread, and then maybe you get a bit of the uplift when it starts to go your way that way. Okay, number 4, bubbles. You never know how far it can go or what might make it pop. I've heard many people who are very successful investors, traders, hedge fund managers, that kind of stuff, say exactly the same thing. We're in a bubble. They know we're in a bubble. Everyone knows it's in a bubble. But what do? You know, do they participate in the bubble? Because that bubble could go on for the next 2 years, 3 years, 4 years, 5 years, a decade. What's the catalyst that's going to make it pop? Often you see with bubbles, something that thinks it's going to make it pop, it's this, it's that, it maybe pulls down and we're off again, it pulls down, we're off again. So they're in a bit of a kind of quandary. They go, okay, do I buy and ride this bubble out and try and guess what the catalyst is that's going to make it pop, or do I wait for the pop and do I short it? It's like the film The Big Short. You know, they saw the bubble, but they went short. You know, the housing market effectively in the US, but of course it went on and on and on because it's very difficult sometimes to time how far it's going to go and what's going to cause it. You know, what's that final straw that's going to make the whole thing cascade down. So coming from him, it makes perfect sense, and I've heard other people say that as well. So how does that affect you and I as kind of retail traders and investors? Again, we've got the same decision to make. Do we get involved in the bubble and be very, very, even if we're aware it's a bubble, do we get involved and say, okay, well, this thing could go on forever, I'm going to get involved in it and push on, but be aware that I'm going to take a haircut by the time it pops. You know, I'm not going to be able to get out of the top. I'm not going to be good enough to predict it because it's very difficult to see what might make it pop. And if you come out and every kind of pull back down, you're not going to participate in the kind of exponential rally that it's got. Or do you wait until you see it starting to pop and then trying to hit it from the short side, which obviously isn't always possible depending on what you're trading. All right, guys, there's 4 actually there. Oh, the final one, 5, which I haven't put on here, which is a great one. He said, so listen, when you leave your job and you go out on your own, don't expect to make any money. Call the hedge fund whatever your wife says you should call it. And I probably should say, or husband. So basically what he's saying there is, and how does that relate to us as traders? If you're deciding to quit and go and do trading or investing full time, you don't expect to make money straight away. You need to learn it and get a feel for it and understand it. And you know, his little kind of joke there was, whenever your partner says you should call your fund, is that what you should call it? Because you need to keep them happy, because you're probably not going to be bringing much money back. All right, guys, that's all I got for you. Take care. See you in the next one. Keep the risk managed. Goodbye.